Hey everybody, Marty Missouri here, the 3rd of May, 2024, with your weekly economic update and stock market technical snapshot, and actually yields, the dollar, and gold snapshots as well. In front of you is the graph of our PWA index. I like to call it our general conditions index. And it did plummet, frankly, week over week. Went from a minus 11 to minus 26. That's as big a 1 week drop as I can remember, folks, in a very long time. So I'm going to run through the inputs that declined. I'll just focus on those this week and give you the texture on those. A lot of it is showing up in the labor market. I've been talking a lot to clients and to some extent on the blog about what we're seeing in the leading employment indicators. I talked about the implications for markets, and believe it or not, they're not bad in the short to intermediate term. If this weakness that we see coming actually continues, and it was reflected today in a weaker than expected jobs number. So if this is going to be the new trend, this ultimately isn't good for asset prices, equities in particular, but that's further down the road. First reaction would be, hey, economy's weakening, therefore inflation should be weakening, therefore the Fed should be loosening, and market's going to love that. Well, that's the narrative. Problem is, if we get to the uh-oh stage where this is serious weakening, it's ultimately a recession, which means it's really rough on corporate earnings, which means stocks are way pricey relative to a recession reality. We're not there yet. It's no longer consensus like it was a year ago, probably quite the opposite. Seems like soft landing is now consensus. I would say there's danger in that narrative, and that's what I'm going to be showing you some of today is hints of that danger, and then of course more evidence if it does continue to evolve over the coming weeks and months. Okay, so as for the negatives, we're going to start with consumer confidence. Last week I pointed to the small decline in the University of Michigan's number, but we're still historically pretty low. Big decline this week in the Conference Board's confidence number, and I'm going to give you some of the detail from that. Fell to 97, as you can see here, from 103, lowest since July of 22. The sum of the questions around present situation fell by 4 points. Expectations fell by a big 8 points. 1 year inflation expectations actually held steady at 5.3%. The key culprit here was the labor market, as I just suggested. Those who said that jobs were plentiful fell by 1.5 points to the lowest since November. Those who said that jobs are hard to get rose by 2.7 points. And in addition, 2.6 point drop in those expecting more jobs in the coming 6 weeks. That's the least since October 2011, and so on. So, weakness in how the consumer feels about their general situation, but certainly definitely not great feelings around their job prospects going forward. So speaking of jobs prospects, the consensus was north of 200,000 new jobs created. We ended up with 175,000. The problem really came from the government sector. The private sector actually added 167,000 of those 175,000 jobs. And the forecast for the private sector was 193,000. So that was still lower than expected. The household survey had 25,000 new jobs and 87,000 people entering the workforce versus the number last month. So that caused just a minor uptick in the unemployment rate to 3.9%, as you see right here. The U6, which is all in, you might say, or captures discouraged workers, part-time workers who want to work full-time and so forth, that popped a bit to 7.4%. Average hourly earnings rose just 0.2%, market like that relative to inflation. The estimate was 0.3%. As for job openings, they dropped by 325,000 to 8.5 million. Again, still a lot, but you can see what the trend has been of late. The quits rate, which is right here, 2.1%. Falling quits rate denotes weakness in the economy versus a high quits rate, which denotes strength. People are very willing to quit their job when they think they have better prospects in the offing. That's declined rapidly. Another sign about weakening in the overall economy, certainly weakening in the labor market. The Institute for Supply Management surveys came out this week. One that really surprised me was services. I did not expect the results of the services survey to show contraction below the 50 line. Manufacturing rolled back over just for a month. It was showing expansion after 16 months, showing contraction, and now it's back into contraction territory. But the services sentiment dropping again was, frankly, is somewhat alarming, but consistent with our go-forward view that we're seeing weakness in the economy. So I wanted to also show the Citigroup Economic Surprise Index. Now it's dropped below zero, and below zero means that the data that's come in lately has actually been notably weaker than what economists had previously anticipated. So folks, one of the terms that I keep hearing is U.S. exceptionalism, meaning how exceptional the U.S. has been relative to other economies. In fact, you could say that many parts of Europe have been in recession, and maybe we're seeing early signs of them emerging from recession. We're seeing that in the data that we look at, and we are accommodating for that actually in our core portfolio, although we're not going crazy right here because I do think there's real risk of what on the charts prior to previous recessions look like what I like to call head fakes. And I've said that about the recent increase in manufacturing sentiment. And sure enough, that looks like maybe indeed it was a head fake. Here's the U.S. again, falling below zero. But take a look here at the other areas. Eurozone, for example, 27, coming down a bit, but still well above zero, meaning data is still coming in better than what economists had expected. Still very much so in Japan with a positive 29. Finally, in China, you can see the data has been coming in a little better than what economists had expected. The emerging market complex overall, very positive, up 32. And then the global economic surprise index, pretty well above zero at 15. The U.S. is going to be dragging that down. So the point here, folks, is that the U.S. did more stimulus far and away than anybody else, and you get those long lags. Maybe now we're actually seeing some weakening in the economy, and I've been talking a lot internally, and I've been noting in our log every day, which I give you kind of the summary of now, just once a week toward the end of the week. But I've been saying in there that this weakness that we see coming, particularly in the labor market, is probably going to be very short-term bullish for equities, and I've already mentioned earlier why that would be the case. Sure enough, I did listen to the entire press conference on Wednesday with Chairman Powell. He essentially said in his response to one question that if we see the labor market begin to roll over, we're going to be cutting interest rates even if inflation remains sticky. Those weren't his words, but make no mistake, that was his implication. So I was writing in our internal log that that's really what the world should be focusing on. And then lo and behold, 2 days later, we get a weak jobs print, and then we get this rip your face off rally in equities. So that makes a lot of sense to me, and that certainly is being borne out in the trading just immediately following my comment and following Powell's press conference. Sectors, so interesting. The sector to SPX ratios are concerning. Now, those of you who've been with me a while recall this is a very busy looking chart, but we're looking for 100 or better or 100 or worse. And if the sector is 100, it's doing exactly what the S&P is doing. If it's better than 100, it's doing better. If it's lower, it's doing worse. And this is for the last month. Tech's underperforming. Financials are underperforming. Discretionary are a tie pretty much with the S&P. Materials way underperforming. Energy way underperforming. Industrials underperforming. So these are your more economically sensitive sectors. Look at your defensive. These are the ones that do well on a relative basis when the economy is weakening. Staples, dramatically outperforming. Utilities, hugely outperforming. Healthcare, hanging in there with the S&P. That had a negative impact on our overall general conditions score. Okay, folks, so I want to get to the technicals because they're interesting, but let me just quickly run through, with more help from our friend Peter Bookvar, some earnings highlights. This week we'll start with the positives. Live Nation, and these are quotes from the earnings call. So just to make sure we hit hard on the consumer demand, we are seeing no weakness. The things that we look at that give us an indication of how the shows are selling, how the fans are spending when they go to the site, all continue to be very strong. We're consistently seeing the sell-through of the shows are at or above where they were last year, and that the overall grosses for the artists are consistently higher. So no issues at all on fan demand relative to last summer. So go ahead and forget about everything I'm talking about with a weakening economy and just go with Live Nation if you want to be bullish, and I could certainly understand why based on that report. Booking holdings. We continue to see resiliency in global leisure travel demand, including healthy growth for travel on the books that's scheduled to take place during our peak summer travel season. From Marriott, once again, we saw RevPAR growth across all three of our customer segments group, leisure transient and business transient, which comprised 24% of global room nights in the first quarter, was again the strongest customer segment. So leisure, right? Concerts, shows, hotels, they're still knocking it out of the park as I speak. Shake Shack, and we're showing solid signs of strength so far this year, and each month we have improved sales. April got even better as we grew same Shack sales by 4.9% with approximately flat traffic. So obviously price increases have helped them there. DoorDash. In general, we're not seeing the signs of strain on the consumer, but I think it perhaps has something to do with the segment that we operate in, which is digital and delivery. I do understand that there are some headwinds that certain merchants face when it comes to in-store traffic, but when it comes to all things digital, we're actually not seeing, I think, those same signs of strains. Even, for example, in the U.S. restaurants business, the growth is pretty consistent over the last 6 quarters. Brinker. We were pleased to see our business immediately bounce back and perform well in February and March, and with Chili's beating the industry sales by more than 7% and traffic by nearly 4% for the entire quarter. We do know that we're growing in all income demographics right now. So when you look at across all income profiles, they're all spending more at Chili's. So we feel really good about that. Domino's Pizza. Our growth in the U.S. came through positive order counts across all income cohorts. In both our carryout and delivery segments, we saw the largest growth in our lower income cohorts that are undoubtedly benefiting from renowned value that we're offering. Amazon, with their AWS, companies have largely completed the lion's share of their cost optimization and turned their attention to newer initiatives. DuPont, our results for the period exceeded our expectations, driven by better than expected volumes in all segments. Broadly, the first quarter confirmed that we are past the bottom in electronics and on the road to recovery. Okay, so that's a lot of good positive feedback. Now, here are some highlights from earnings reports that aren't quite so rosy. Also from Amazon. We remain focused on making sure we're offering everyday low prices, which we know is even more important to our customers in this uncertain economic environment. As the results show, customers are shopping, but they remain cautious, trading down on price when they can and seeking out deals. As part of our guidance considerations, we also continue to keep an eye on consumer spending and macro level trends, especially in Europe, where it appears to be a bit weaker relative to the U.S., despite what I just said about Europe. From McDonald's, as I reflect on the first quarter of the year, it is clear that broad-based consumer pressures persist around the world. Consumers continue to be even more discriminating with every dollar that they spend as they face elevated prices in their day-to-day spending, which is putting pressure on the QSR industry. Starbucks. Our performance this quarter was disappointing and did not meet our expectations. Headwinds discussed last quarter have continued. In a number of key metrics, we continue to feel the impact of a more cautious consumer, particularly with our more occasional consumer. And a deteriorating economic outlook has weighed on customer traffic, an impact felt broadly across the industry from Black & Decker. Looking forward in 2024, we expect mixed demand trends to persist across our businesses. Aero Electronics, as we take a closer look at global components, the cyclical nature of this business is a reality, and we're navigating through a prolonged correction as customers restock surplus inventory levels, which accumulated in response to the severe shortages that marked the industry supply chain disruptions of the pandemic. We continue to witness knock-on impact of the demand environment with softness across many of the markets we serve. From CDW, and I'm just going to start paraphrasing. I've been reading too much of these. Market conditions remain challenging, and first quarter results came in below our expectations. From Gartner, Q1, our clients experienced more challenging macroeconomic conditions, which led to a tougher selling environment. From onsemi, inventory digestion persisted across the automotive and industrial markets with stabilization in the traditional part of our industrial business. We remain cautious about the second half outlook. From Etsy, overall, we see this as a tale of broad weakness in the types of merchandise we sell. eBay, we continue to navigate through a tough environment for discretionary e-commerce. SoFi, as we shared last quarter, we've taken a more conservative approach towards originations, given our concerns around rate uncertainty and the broader macro climate. Mohawk, across our regions, market conditions remain similar to the prior quarter with significant pricing and mixed pressure due to industry competition and volume. Though slowing, the commercial channel continues to outperform residential. Residential remodeling remains soft due to low housing sales and the impact of inflation on discretionary spending. Retailers have reported that consumers are reluctant to initiate higher ticket projects, with flooring facing greater pressure since most replacements can be readily deferred. Okay, so clearly when we peruse the earnings call commentaries, what I'm gleaning is that folks are perhaps hitting the expensive fast food, which is now expensive fast food less, places like Starbucks less, wanting those experiences that they get from vacations and concerts, etc. Makes you wonder how long that's going to last when you look at the spending down of the pandemic savings rates falling, credit card debt rising, delinquencies rising, and so on. This just doesn't smell well to us going forward. But again, as I continue to show you here, it ain't all bad, and need to remain open to all possibilities. But this does not feel like the bottom of a downturn with a new upturn ready to take off. It feels very late cycle to us still right here, at least in the U.S. Okay, so let's get to the technicals. So folks, recall we had a really classic looking bear flag pattern. It broke down just like it should, Tuesday, Wednesday, and Thursday. And I think the market was anticipating, number one, a hawkish Jerome Powell, which it didn't get. So his dovishness coupled with weak jobs data. Again, this big jump in the market was on weaker than expected economic data, and I've talked about why that makes perfect sense to me. Technically speaking, the S&P stopped right at the 50-day moving average. The fact that it went above it and couldn't close above it is not a great short-term sign. All it means is that it hit resistance right there, which makes sense. As you can see, it was resistance right here as well. Right at the top of the flag of that particular flag pattern. So we'll see what happens next week. When we look at the momentum indicators, we have a nascent buy signal from below zero. That's positive. We have the RSI moving up. There's no divergences here. It's pretty much moving with price, so that's not negative. When we look at the Qs, the NASDAQ 100, again, remember that 20-day moving average that's been so important was pretty strong resistance. Looks like that was going to hold until we got the jobs number today. Stopped like the S&P right at the 50-day moving average. Same buy signal in here on the MACD. Same look with the RSI. Yields, remember we had yields on the rise, which were very bearish for stocks during the month of April. The S&P gave back like 4%. S&P equal weight, I think closer to 5% last month. I was showing you here that we had some bearish divergences, and the odds favored that they would roll over, and that ultimately right here, the way things are trading, would be bullish for stocks, and that's what we've seen so far this week anyway. The dollar, this bull flag pattern played out absolutely perfectly. Actually, it hit the target right here. Hit it again, fell apart. We had big bearish divergences, and we were looking at this and saying, you know what, that dollar looks ripe to roll over. If the Fed comes in soft or the employment data comes in soft, dollar's rolling over. Very bullish for stocks, and that's exactly how it turned out. Gold, we have a not small position in gold. We did hedge it right in here just off the top with a out of the money put option just to protect from anything major from happening. As you can see, we gap down right there. Keep coming back to the bottom of the gap. Still got a ways to go to refill it. Gapped again right here 4 days ago. Came up the next day right to the top of the gap and then fell back off of that. Sitting right here at about 210 support. Gold was up a little bit today. You would think that with yields rolling over that gold would be more bullish right here. Gold's been trading a little bit oddly relative to the dollar and relative to yield. So we'll see what will inspire it going forward. I do think there's a lot of people who want to engage with gold, and if they missed the rally here, we might see some buying. It can be so volatile, and we're concerned. We've had a really nice year in gold so far. We don't want to give back all those gains, but we don't want to exit the position either. That's why it was easy to buy an 8 or 10% out of the money put option. Just to protect against something major. I think central banks want to own more of it and so forth. But anyway, so it's going to be interesting to chart. I didn't pull up the copper chart. I've been talking about the suspect looking technicals. Copper has been rolling over a little bit of late with most commodities as well. So folks, that was a ton, much longer than I anticipated. I got carried away by the earnings call commentary, but I think that's important stuff, and some of the feedback I've gotten suggests that that seems to be of value to viewers of these videos. So stay tuned, folks. Lots to come in the coming weeks and months, and we'll bring it to you once a week in a summary of our internal notes or highlights of our internal notes, and then I'll do at least one video for you a week as well going forward. Have a great day. Talk to you soon. Bye-bye.